You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Right now, 87% of people listening to this who own a health savings account are, well, they're actively losing money to inflation. I mean, they are treating the absolute ultimate tax loophole like a low-yield checking account.
Yeah, it's wild.
The data we're looking at today shows that only 13% of HSA owners actually invest their funds. Just 13%. The vast majority are sitting on an account that the IRS has effectively structured as like a perfectly legal, heavily subsidized offshore tax haven, right? And they're using it to hold $50 to pay for a random dental copay.
I mean, it really is a massive systemic failure of financial education, combined with, honestly, a genuinely terrible user experience from the employer-provided health plans that administer these accounts in the first place.
Right. The portals are awful.
They're so bad. We constantly see people handed an HSA debit card during open enrollment, and because it looks exactly like the card they get for a standard flexible spending account, the behavioral conditioning just kicks in immediately.
Yeah, they just swipe it.
Exactly. They assume it's just this temporary digital wallet for the pharmacy that they need to, drain by the end of the year.
And that systemic failure is exactly what we are dismantling today.
Mm-hmm.
We've pulled together this really comprehensive stack of sources. Research from financial advisors, institutional data from Charles Schwab, deep dive manuals from health agents, and some really advanced investment guides.
It's a lot to get through, for sure.
It is. But our mission for this deep dive is to deconstruct the mechanics of the HSA. By the time we finish, you'll understand how to transition from, passively ignoring this account to actively weaponizing it as a parallel retirement vehicle. But I think we need to start with the foundational math.
Yeah.
Because to understand why this account requires a total perspective shift, you really have to look at how it breaks the conventional rules of the U.S. tax code.
It genuinely is a mathematical anomaly. Financial professionals refer to it as the triple tax advantage.
Right.
Which I know, it sounds like marketing jargon until you actually place it side by side with every other investment vehicle available to you. Like, if we look at a traditional 401k, the IRS offers you a front-end deal, right? You get a tax deduction on the money you contribute today, which lowers your current taxable income.
Which is great.
It is. And the money compounds without tax drag while it remains in the account. But the IRS is patient, When you reach retirement and begin taking distributions, every single dollar you withdraw is taxed as ordinary income.
Okay, let's unpack this for a second. Because you're essentially taking a mortgage out with the IRS. You get the house now, but they own a percentage of your future cash flow.
That's a great way to put it, yeah.
And then a Roth IRA just inverts that timeline, right? You pay the taxes up front on the seed money, it grows without tax drag, and the harvest is tax-free. In both of those standard scenarios, the house always takes a cut. It's just a matter of when.
Precisely. The standard tax code forces you to choose your pain point. Are you taking front-end pain or back-end pain? The HSA is literally the only account in existence that eliminates the pain entirely.
No pain at all.
None. The contributions go in tax deductible, which slashes your current tax burden. The investments compound internally with zero tax drag on the capital gains or dividends. And when you withdraw the funds, provided they're applied to qualified medical expenses, the distributions are completely tax-free.
It's incredible.
It's the only ecosystem where a dollar can enter, multiply tenfold over 30 years, and exit without the IRS ever claiming a fraction of a cent.
And while that triple advantage is the headline that, like most financial blogs, just copy and paste, our sources dive into a secondary mechanism that drastically amplifies the upfront yield.
Yeah.
It's an immediate arbitrage opportunity regarding payroll taxes, specifically FICA.
Oh, the FICA bypass. It is perhaps the most underutilized lever in corporate compensation today.
Yeah, nobody talks about it.
No one. When you make a standard contribution to a 401k, you avoid federal and state income tax on that money, sure. But your employer still withholds FICA taxes, which funds Social Security and Medicare. For a W-2 employee, that's a flat 7.65% tax on your gross wages up to the annual limit. However, because of the way HSAs interact with Section 125 cafeteria plans, contributions made directly through employer payroll deductions are entirely exempt from FICA taxes.
So if we run the actual math on a marginal dollar, the efficiency is just staggering.
It really is.
If you're in the 24% federal tax bracket and say A 5% state income tax bracket, a standard retirement contribution saves you 29% in taxes today. But if you route that exact same dollar through payroll into an HSA, you add the 7.65% FICA savings on top of that.
Right.
You are instantly capturing an immediate risk-free return of over 36% before that dollar ever even enters the equity markets.
It fundamentally changes the ROI of your initial contribution. But, and this is huge, there is a vital mechanical trap here that the Greenbush financial source highlights.
Oh, yeah, the manual transfer trap.
Yeah, exactly. The IRS tax code does not allow individuals to reconcile FICA taxes on their standard Form 1040 at the end of the year. So if you decide to, say, bypass your HR department and just manually transfer funds from your personal checking account into your HSA.
So you're just linking your bank account and moving it over.
Right. If you just do a manual ACH transfer, you can still claim the federal and state income tax deductions when you file your taxes in April. But you have permanently lost the FICA exemption. That 7.65% is gone, and the IRS will absolutely not refund it to you.
That is such a critical operational detail.
Huh.
To optimize the input, the money must flow through the payroll plumbing. Now, there was one geographical anomaly we need to address before we move on. The federal government treats the HSA as this sovereign tax-free state, but 2 specific states do not recognize that sovereignty.
Right. California and New Jersey.
Always making things complicated.
Yeah, they do. If you're a resident filing income taxes in either of those states, you face a unique administrative headache. Both states recognize the federal deduction for the initial contribution, but they treat the internal growth, so the dividends, the interest, the capital gains, as fully taxable state income in the year it's realized.
Wow. Which means if you are aggressively trading inside your HSA in California, you're generating taxable events at the state level every single time you sell a position for a profit, even if the money never leaves the HSA wrapper.
Precisely. That necessitates keeping 2 completely separate sets of accounting books for your cost basis. One for the federal government showing a tax-free haven, and one for the state showing a standard taxable brokerage account.
What a nightmare. So what's the workaround for people living there?
Well, for residents of those states, the optimal strategy often involves buying and holding highly tax-efficient equity index funds and just avoiding bonds or dividend-heavy assets inside the HSA altogether, simply to minimize the ongoing state tax drag and the reporting nightmare you just mentioned.
Okay, so the mathematical superiority of the account is undeniable. We've got the federal triple tax advantage, compounded by the FICA payroll bypass. But this level of tax optimization isn't just handed out freely to the general public.
No, it's not.
The IRS puts a pretty significant gatekeeper in front of it. You cannot simply log into a brokerage and open an HSA because you feel like it. You have to qualify, and the qualification mechanism is very specific.
The gatekeeper is the High Deductible Health Plan, or HDHP. Under IRS regulations, you must be actively enrolled in a qualifying HDHP and have no disqualifying secondary coverage on the first day of the month to be eligible to contribute to an HSA for that specific month.
So let's pull the exact 2026 parameters from the Illinois Health Agent's source. Because high deductible isn't a subjective marketing term here, right? It's a rigid legal definition.
Oh.
What are the actuarial floor and ceiling that actually define these plans?
Yeah, the IRS is very strict on this. For the 2026 tax year, the IRS stipulates that an individual plan must have a minimum deductible of at least $1,700, and a family plan must have a minimum deductible of at least $3,400. That's the floor, meaning your insurance will not provide any non-preventative coverage until you've paid that amount entirely out of your own pocket.
Right. And what about the ceiling, the maximum exposure?
The plan also has to cap your out-of-pocket maximum. So for 2026, an individual cannot be liable for more than $8,500 in a year, and a family cannot be liable for more than $17,000.
Okay.
If a health insurance plan falls outside of those specific parameters, for instance, if the deductible is $1,700 but the out-of-pocket maximum is, say, $10,000 for an individual, it legally ceases to be an HDHP and immediately disqualifies you from making HSA contributions.
Wait, isn't a high deductible inherently a bad thing, though? Like, why would anyone volunteer to pay more out of pocket just to get this account?
It's a great question, and it's the main psychological barrier for most people. But it comes down to calculating annualized risk versus annualized fixed costs. When you choose a traditional PPO plan with a low deductible, you aren't avoiding the cost of healthcare. You're just prepaying for it in the form of astronomically higher guaranteed monthly premiums.
Right.
You're paying the insurance company a massive premium to act as a highly inefficient middleman for your routine, predictable expenses, like, a sinus infection or generic prescription.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
If we look at the actuarial tables, the insurance companies are pricing in the administrative bloat of processing millions of tiny claims. They're charging a premium on top of the premium for the convenience of you just having a $20 copay.
Exactly. The high-deductible health plan strips away that middleman for the small stuff. By agreeing to self-insure the first few $1,000s of risk, your guaranteed monthly premiums plummet.
So where does the math work out in the patient's favor?
The mathematical optimization occurs when you take the difference in premiums, the money you saved by not buying the expensive PPO, and route it directly into the HSA, capturing the tax deduction and the FICA savings along the way. For anyone who doesn't have chronic, expensive medical conditions, the combined premium savings and tax arbitrage often far exceed the higher deductible exposure. You're effectively building your own personal insurance company with heavily subsidized government dollars.
Okay, but beyond the plan design itself, the IRS is incredibly strict about intersecting coverage. You mentioned disqualifying secondary coverage earlier. And the most notorious trap here, the one that just ruins the tax strategy for thousands of people every open enrollment, is the standard flexible spending account.
Oh, the FSA trap. It is brutal because it operates on the principle of first dollar coverage.
Can you explain that for us?
So the IRS logic is this. The primary requirement of an HDHP is that you, the patient, bear the initial financial risk up to that $1,700 or $3,400 deductible. A general-purpose FSA provides you with pre-tax dollars that you can use to pay that deductible from day one. Therefore, the IRS views the FSA as active secondary insurance that fundamentally breaks the high deductible requirement. If you, and this is important, your spouse enroll in a general-purpose FSA, you are both completely locked out of contributing to an HSA for that entire plan year.
Wait, really? The spouse detail is vital. Even if you maintain separate insurance plans, if your spouse opens an FSA that technically could be used to cover your medical expenses, it taints your HDHP status.
Yes. The IRS treats it as joint access to first dollar coverage.
Now, there is a workaround for this, isn't there? The limited purpose FSA.
Yes, the LPFSA. It's specifically engineered to coexist with an HSA. It operates identically to a standard FSA, but the funds can only be used for eligible dental and vision expenses, not general medical costs.
Because dental and vision are generally carved out of standard health insurance deductibles anyway.
Exactly. So the IRS allows you to stack an LPFSA on top of an HSA, allowing you to shelter even more pre-tax money specifically for things like braces or LASIK surgery, while preserving the HSA for long-term investing.
That's super smart. Our sources also point to a major shift in the insurance landscape arriving in 2026 regarding the Affordable Care Act marketplace.
Yeah, it's a massive expansion of access. Starting in 2026, federal regulations dictate that all bronze and catastrophic tier health plans sold on the ACA marketplace will automatically be structured to be HSA eligible.
Oh, wow.
Right. Historically, gig workers, freelancers, and early retirees had to dig through complex plan documents to verify if a marketplace plan met the strict HDHP criteria. Now, that entire lower premium tier is standardized as a gateway to the HSA.
Okay, so once we've made the actuarial decision, accepted the deductible risk, and secured the HDHP, we have the account open.
Yeah.
The immediate objective becomes maximizing the capital inflow. Let's break down the exact capacity of this vehicle based on the 2026 limits.
The IRS sets strict annual constraints here. For 2026, an individual with self-only HDHP coverage can contribute a maximum of $4,400. For anyone covering at least one other person on a family HDHP, the limit effectively doubles to $8,750.
And maxing this out every year and investing the balance rather than spending it, that's what creates this powerful parallel retirement account.
Exactly.
Now, as with most tax-advantaged accounts designed to supplement retirement, there is a catch-up provision for older demographics, right?
Yes, individuals aged 55 and older are permitted to contribute an additional $1,000 per year. However, the administrative mechanics of this catch-up contribution for married couples are famously convoluted, and the Greenbush source goes out of its way to warn about this specific trap.
Because unlike a joint brokerage account, An HSA is strictly an individual trust tied to a single Social Security number.
Precisely. Let's assume you and your spouse are both over 55 and covered under a single-family HDHP. The logical assumption is that you could simply deposit the $8,750 family maximum plus both of your $1,000 catch-up contributions, totaling $10,750 into the primary HSA account held by the policyholder.
Which makes sense logically.
It does, but the IRS absolutely prohibits this.
Because the secondary spouse doesn't technically own the primary HSA trust.
Right. To capture that second $1,000 catch-up contribution, the non-policyholding spouse must go through the administrative friction of opening a completely separate, standalone HSA in their own name, tied to their own Social Security number. And they have to deposit that $1,000 into that specific account.
It's an annoying hoop to jump through.
It is a structural annoyance, for sure, but failing to execute it properly results in excess contribution penalties.
Speaking of structural rules that trap people, we need to dissect the timeline constraints. Specifically, what happens when someone changes their insurance mid-year. Let's say a listener gets a new job or goes through open enrollment, and their new HDHP coverage activates on December 1st, 2026. Have they missed out on the $8,750 tax shelter for that year?
They have not, thanks to a very specific IRS loophole known as the last month rule.
I love a good loophole.
It's a great one. The rule states that if you are fully eligible to contribute to an HSA on the first day of the last month of your tax year, which for almost everyone is December 1st, the IRS treats you as if you were eligible for the entire preceding 12 months.
Wait, really? So even if you spent January through November on a traditional low-deductible PPO, you can switch on December 1st and instantly dump $8,750 into the HSA before December 31st and claim the massive tax deduction for the entire year.
You can. It is an incredibly powerful maneuver for sheltering a lump sum of income right at the end of the year. However, the IRS does not offer this kind of retroactive benefit without a corresponding enforcement mechanism.
There's always a catch.
Always. If you utilize the last month rule to make a full year's contribution, you trigger what the IRS defines as a testing period.
And this is where people get burned if they don't understand the commitment they just made.
Yeah, they get burned badly. The testing period dictates that you must maintain continuous eligibility, meaning you must stay enrolled in an HDHP for the entire following calendar year, all the way through December 31st, 2027.
Okay, so a full 13 months.
Yes. If you break that eligibility at any point during those 13 months, perhaps you switch jobs in June and take a traditional health plan, the penalty is severe. The portion of your contribution that you are not prorated for based on actual months of coverage is immediately pulled back into your taxable income for that year, and the IRS slaps an additional 10% penalty on top of it.
So it's a calculated risk.
Whack.
It's a fantastic tool if you are confident in your employment and your insurance strategy, but it requires a strict 13-month commitment to the HDHP ecosystem to avoid the penalty clawback.
Exactly.
Now, beyond standard payroll deductions, the Charles Schwab documentation highlights a highly specialized funding mechanism that I want to explore. It operates completely outside the normal cash flow channels. They outline an IRA to HSA rollover.
Oh, this is fascinating. This is technically defined as a Qualified HSA Funding Distribution, or QHFD. The IRS allows you, exactly once in your lifetime, to execute a direct transfer of pre-tax funds from an individual retirement account, like a traditional IRA, straight into your health savings account.
At first glance, moving money from one tax-advantaged account to another seems like a lateral move. Like, why would someone burn their once-in-a-lifetime exemption to do this?
It's about changing the exit taxation of those dollars in the face of a liquidity crisis.
Okay, give me an example.
Imagine a scenario where you're hit with a catastrophic, unexpected medical emergency early in the year. You're on an HDHP, so you immediately hit your $8,500 out-of-pocket maximum. But because you just opened the HSA, the balance is zero, and you simply don't have $8,500 in liquid cash in your checking account to make a deductible contribution today to cover the bill.
Okay, so you went cash fast.
Yeah.
But if you try to pull $8,500 out of a standard traditional IRA to pay the hospital, that distribution is added to your adjusted gross income for the year, right?
Mm-hmm.
And you're taxed on it at your highest marginal rate, plus a potential 10% early withdrawal penalty if you're under 59.5.
Exactly. The traditional IRA distribution is highly inefficient for immediate medical debt. But if you utilize the QHFD, you directly transfer that $8,500 from the traditional IRA into the HSO.
Oh, I see where this is going.
Right. That transfer is not a taxable event. The money is now inside the HSA ecosystem. You then immediately withdraw it from the HSA to pay the hospital bill. By passing it through the HSA first, you have effectively washed the money, transforming a highly taxable retirement distribution into a completely tax-free medical payout.
What's fascinating here is how you've constructed a tax-free pipeline straight from your long-term retirement assets to your immediate medical liabilities.
Brilliant.
But given how protective the IRS is of tax revenues, I imagine the compliance guardrails on this maneuver are pretty extensive.
They are. First, the rollover amount counts dollar for dollar against your annual contribution limit. You can't use this to push 50 grand into an HSA. You're still capped at the $4,400 or $8,750 maximum. Second, it requires a direct trustee-to-trustee transfer. If the IRA custodian cuts you a check and you try to deposit it into the HSA yourself, you violate the rule and it becomes a taxable IRA distribution.
Okay, so the banks have to talk to each other directly.
Exactly. And finally, just like the last month rule, executing a QHFD triggers a strict 12-month testing period. If you drop your HDHP coverage within a year of the rollover, the transferred amount becomes fully taxable and subject to a 10% penalty.
So it's a transitional relief valve. You wouldn't use it as a primary accumulation strategy, but as an emergency ripcord when facing a massive medical shock and a cash flow deficit. It's an unparalleled mechanism.
Precisely.
All right, so up to this point, we've established a theoretical framework. We know how the tax code treats the account, how to qualify for it, and how to pump maximum capital into it. Now we have to address the behavioral pivot that separates the 13% who are building massive wealth from the 87% who are just using it as a pass-through entity. We're entering the advanced mechanics of what is commonly referred to in financial planning circles as the shoebox strategy.
I love the shoebox strategy. This strategy relies on exposing the fundamental flaw in how the HSA is marketed to the public.
Which is?
When an employer hands you an HSA, they give you a glossy brochure and a plastic debit card, heavily implying that the account is a transactional checking account. The conditioning is immediate, right? You contribute from your paycheck, you go to the pharmacy, you swipe the card, the balance drops to zero.
Right. You capture the upfront tax deduction, which is beneficial, but you have systematically murdered the other two components of the triple tax advantage.
Exactly.
You allowed zero time for tax-free compounding, and because there was no growth, the tax-free withdrawal is applied to a tiny principal amount rather than decades of accumulated capital gains.
You've completely neutralized the vehicle. To unleash the actual mathematical power of the HSA, you must sever the connection between the account and your current medical spending. The strategy is straightforward but requires significant behavioral discipline. If you have the cash flow, you pay for every single current medical expense, the co-pays, the prescriptions, the dental work out of your standard after-tax checking account. You do not touch the HSA. You invest the HSA funds in the equity markets and let them compound for decades.
Okay, but the defining characteristic of the account is that withdrawals are only tax-free if used for qualified medical expenses. If I'm cash flowing my medical life today from my regular income, how do I ever access the hundreds of thousands of dollars compounding in the HSA down the line without triggering a massive tax bill?
This is where we leverage a specific omission in the IRS tax code. Section 223 of the Internal Revenue Code, which governs HSAs, contains exhaustive regulations on what constitutes a qualified medical expense, eligibility, and contribution limits. But it is entirely silent on one critical metric: time. There is absolutely no statutory deadline for when you must reimburse yourself for a medical expense.
Here's where it gets really interesting. Let's trace the mechanics of that reality.
Mm.
You were telling me that I can go to a specialist tomorrow in 2026, pay a $250 bill out of my normal checking account, save the receipt in a digital file, and then in the year 2056, 30 years from now, I can present that exact same $250 receipt and withdraw $250 from my HSA entirely tax-free.
That is precisely the mechanism. As long as the medical expense occurred after the specific date your HSA was legally established, and you have not previously claimed that expense as an itemized deduction on your Schedule A, it remains a valid, open claim against your HSA balance indefinitely.
Think about the compounding math of that $250 over 30 years. If that money was left inside the HSA and invested in a broad market index fund, yielding a conservative 7% real return after inflation, it doubles roughly every 10 years. That initial $250 contribution grows to $500, then $1,000, and eventually over $2,000 by 2056.
Right.
I'm pulling out $2,000 in tax-free purchasing power in retirement, all justified by a stack of minor medical receipts generated decades earlier. I'm essentially using my past medical misery as a tax-free ATM card for my future.
It is the ultimate asset location strategy. You build a massive digitized ledger of unreimbursed medical expenses over the course of your working life. Every Band-Aid, every pair of contact lenses, every urgent care visit is tracked and filed away. When you reach retirement and you need capital to fund your lifestyle, whether that's buying a vacation property, covering living expenses, or simply reallocating assets, you begin cashing in that historical ledger.
Wow.
The withdrawals are legally classified as medical reimbursements, rendering them completely tax-free even if you are using the actual cash to buy groceries today.
Let's ground this theory in the practical case studies provided by our ATI transcript source, because the divergent outcomes based on when someone adopts this strategy are striking. Let's start with Tony, who represents the baseline investor.
Right, so Tony is 30 years old. He contributes $3,000 to his HSA this year. Crucially, Tony does not spend it, but he also doesn't engage in the complex record-keeping of the shoebox strategy. He simply invests the $3,000 in a low-cost S&P 500 index fund and ignores it.
Okay, pretty standard.
Assuming a historical 7% return over 25 years, that single $3,000 contribution compounds to roughly $16,000. Because there's no tax drag, no capital gains taxes trimming the growth every year, the velocity of compounding is highly efficient. Tony has built a $16,000 dedicated healthcare fund for retirement from a single action.
Which is excellent. But then the source contrasts Tony with Mia, who they designate as the early planner. Mia is weaponizing the ledger.
Mia is executing the shoebox strategy with absolute precision. She is maxing out her contributions annually and aggressively investing them. Simultaneously, she is cash flowing all her medical costs and digitizing the receipts. Fast forward 30 years, Mia doesn't just have an HSA balance in the hundreds of thousands of dollars. She has a corresponding shadow ledger of tens of thousands of dollars in accumulated historical receipts.
So what's the end result?
While Tony has a great healthcare emergency fund, Mia has constructed a completely tax-free parallel income stream that operates identically to a Roth IRA, but one that was funded with pre-tax dollars. She has completely hacked the tax code.
And what about the administrative burden of that shadow ledger? I mean, the IRS is going to want proof if they audit that timeline.
The documentation requirements are strict, but they're manageable. In the event of an audit, the IRS requires 3 things to validate a reimbursement: proof that the expense was not reimbursed by any other insurance, proof that you actually paid it out of pocket, and proof that it was a qualifying medical expense under IRS Publication 502.
So, no double dipping.
Right. This means keeping the explanation of benefits from your insurance company alongside the final itemized provider receipt and the credit card statement showing payment. Modern cloud storage makes this trivial, you know. You scan the documents, tag them by year, and secure them.
The final case study in the source is Alex, who represents the later stage adopter. Alex is 45. Maybe he spent his 30s just using the HSA as a checking account, but now he understands the math.
For Alex, the strategy pivots slightly away from the extreme shoebox ledger and focuses purely on mitigating the sequence of returns risk for healthcare and retirement. Fidelity's annual institutional research consistently estimates that a couple retiring at age 65 today will require roughly $300,000 to cover out-of-pocket healthcare costs throughout their retirement.
$300,000, that's a lot.
It is. If Alex starts aggressively funding the HSA at 45 with $5,000 annually and keeping it fully invested, he builds a massive dedicated healthcare war chest over 20 years.
And the strategic value of that war chest isn't just having the money. It's about protecting his other assets. Right?
Exactly.
Wow.
If a massive medical bill hits Alex at age 70 and he doesn't have an HSA, he's forced to pull a huge lump sum out of his traditional 401k. That withdrawal spikes his taxable income for the year, potentially pushing him into a higher marginal tax bracket and potentially triggering IRMAA surcharges, which drastically increases Medicare premiums. It's a cascading negative tax event. Having the heavily funded HSA allows Alex to absorb massive healthcare shocks without ever touching his taxable retirement assets, completely insulating his broader financial plan.
The math behind these strategies is airtight. The tax advantages are unparalleled, which brings us to a glaring contradiction. If this is the most efficient wealth-building tool available, why is the user experience so universally terrible?
Yeah, it's frustrating.
This is where we need to examine the mechanics of actually getting the money into the market, because most people log into their employer's HSA portal, try to buy a basic index fund, and run into a brick wall of institutional incompetence.
It's arguably the most frustrating aspect of the entire ecosystem. The vast majority of employer-provided HSA administrators are legacy banks or regional health administrators. They view the HSA not as an investment vehicle, but as a depository account meant to generate interchange fees from debit card swipes and net interest margin on the cash balances.
So they actively disincentivize investing.
Completely. Many employer HSAs simply do not offer a brokerage window at all. They force your funds into a cash account yielding fractions of a percent. For the ones that do offer investments, the structure is often predatory.
How so?
They impose arbitrary requirements, like forcing you to keep $2,000 in cash before you can invest a single dollar. Then they charge a $4 monthly investment access fee. And to make matters worse, the only mutual funds available on their platform are actively managed funds with exorbitant expense ratios, often north of 1%.
Let's quantify that drag for a second. If you're paying a $4 monthly fee plus a 1% expense ratio on your investments, you are bleeding capital. Over a 30-year compounding horizon, those fees will literally cannibalize tens of thousands of dollars of your final balance.
It's absurd.
But we established earlier that you must use the employer's payroll system to capture the 7.65% FICA tax savings. So the listener is trapped, right? They have to use the bad employer HSA to get the money in optimally, but leaving it there destroys the compounding. What is the precise mechanism to escape this?
The escape hatch is a procedure known as a direct trustee-to-trustee transfer. The strategy involves maintaining two separate accounts. First, you set up your payroll deductions to flow automatically into the subpar employer-provided HSA. This action secures your federal and state tax deductions, and crucially, it locks in the FICA tax bypass.
You capture the upfront arbitrage.
Right. Then, entirely on your own, you open a secondary, self-directed HSA at a modern retail brokerage. The sources specifically highlight institutions like Fidelity, Charles Schwab, and Lively. These platforms treat HSAs exactly like standard brokerage accounts. Zero minimum balances, zero monthly maintenance fees, and access to thousands of low-cost ETFs and index funds with expense ratios as low as 0.03%.
Now we have the money in the bad account, and we have the good account open. How do we move it without triggering an IRS audit?
Periodically, perhaps quarterly or once a year, you initiate a transfer request from the good brokerage, asking them to pull the funds from the bad employer HSA. This is the direct trustee-to-trustee transfer. The money moves electronically between the institutions. Because the funds never touch your personal checking account, the IRS does not view it as a distribution.
So no tax hit.
Right. There are no taxes, no penalties, and crucially, there is no limit to how many times you can execute this maneuver in a calendar year.
We have to differentiate that from an indirect rollover, though, because that is where people accidentally trigger massive tax bombs.
It is a critical distinction. In an indirect rollover, the bad employer HSA cuts a check made payable directly to you. You deposit it in your bank account, and the IRS rule states you have exactly 60 days to deposit those funds into the new good HSA.
And if you miss it?
If you miss that 60-day window by even a single day, the entire amount becomes fully taxable income, subject to a 20% penalty. Furthermore, you are legally only allowed to perform one indirect 60-day rollover per rolling 12-month period. It is highly risky and entirely unnecessary. Always demand a direct trustee-to-trustee transfer where the check is made payable to the new institution, not to you.
Is setting up a secondary self-directed HSA and doing manual transfers really worth the hassle? I can hear the listener evaluating the administrative friction right now. Setting up a secondary brokerage account, initiating manual transfers every few months, navigating the customer service of legacy banks.
It comes down to valuing your time. If you calculate the compounding difference over 20 years between a legacy account charging a 1% expense ratio and a Fidelity account charging 0.03%, the gap is measured in the tens of thousands of dollars.
Right.
By spending 30 minutes a year initiating an electronic transfer, you're effectively paying yourself thousands of dollars an hour for that administrative work. It is one of the highest leverage financial actions you can take.
Once the capital is safely housed in the zero-fee brokerage, we have to determine the deployment strategy. Because the underlying reality is that you are still actively enrolled in a high-deductible health plan. You still have massive short-term exposure. If you invest every single dollar in the S&P 500 today, and the market drops 30% tomorrow, and you tear your ACL the next day, you are in a catastrophic position.
Yeah, you really are.
You'd be forced to liquidate equities at the exact bottom of the market just to cover your deductible.
Which is why the Illinois Health Agent's source insists on establishing a cash buffer before you buy a single share of stock. The mathematics of risk management dictate that you must maintain a liquid cash position inside the HSA equal to at least 1, and preferably 2, times your annual HDHP deductible.
So if your individual deductible is $1,700, you park at least $3,400 in the core settlement fund of the HSA, earning money market rates. It acts as an internal shock absorber.
Exactly. It ensures that standard volatility in the equity markets doesn't dictate your ability to access healthcare. Once that $3,400 buffer is established, every subsequent dollar that flows into the account is deemed excess capital, and that is what you deploy into the market.
And how should we structure that deployment? The sources provide a highly specific, age-based glide path for the asset allocation.
Because the HSA is functioning as a parallel retirement vehicle, the asset allocation should mirror the risk profile of your long-term retirement accounts, scaling risk down as your time horizon shortens. For investors in their 20s and 30s who have decades to absorb market downturns, the recommendation is aggressive: 90% in broad market equities and 10% in bonds. The goal is maximum capital appreciation.
As we transition into peak earning years, the 40s and 50s,
the focus subtly shifts toward capital preservation alongside growth. The model suggests moving to a 60-40 split, 60% in equities to combat inflation and 40% in fixed income to dampen the volatility of the portfolio.
And as we approach the transition phase, ages 55 to 65,
here, sequence of returns risk becomes the dominant threat. If a massive bear market hits right as you retire and your healthcare costs spike, drawing down the portfolio can permanently impair it. The recommendation shifts to 50% equities, 30% bonds, and crucially, expanding the cash buffer to 20% of the total portfolio. You are actively building liquidity to weather a multi-year market downturn without selling assets.
and finally, post-65, deep into retirement.
40% equities, 40% bonds, and 20% cash. Throughout all these stages, the central tenet remains constant. Utilize broadly diversified, low-cost index funds. Do not attempt to pick individual stocks inside an HSA. The entire strategy relies on capturing the long-term historical beta of the market in a tax-free environment.
Right. This perfectly stages the final phase of our analysis. We need to look at the end game. A significant psychological hurdle for high-income earners who aggressively overfund these accounts is the fear of being too healthy.
Yes, the too healthy fear.
They project out the compounding math, realize they might have $300,000 in an HSA by age 65, and panic, thinking, what if I simply don't generate $300,000 worth of qualified medical expenses before I die? Have I permanently locked up my capital in a restricted medical trust?
It is the most common hesitation, and it's completely resolved by a specific structural transformation built into the tax code. The IRS provides an absolute release valve, commonly referred to as the age 65 rule.
Prior to age 65, the penalties for unauthorized access are draconian.
Extremely draconian. If you're 50 years old and you withdraw $10,000 from your HSA to, say, buy a kitchen remodel, the IRS forces you to add that $10,000 to your taxable income, and then they assess a punitive 20% penalty on top of it. It's designed to aggressively discourage using the account as a piggy bank.
But what happens the day you turn 65?
The metamorphosis is instantaneous. At age 65, the 20% penalty is permanently abolished. From that day forward, you can withdraw funds from your HSA for absolutely any non-medical reason whatsoever. You can use the capital to buy a boat, fund a grandchild's education, or pay your property taxes.
But the tax status of those withdrawals changes, correct?
Yes. If you withdraw the money for non-medical reasons after age 65, the withdrawal is treated exactly like a distribution from a traditional 401k. It's taxed as ordinary income at your current marginal rate. However, if you continue to use the funds for qualified medical expenses, or if you're cashing in the decades of receipts from your shoebox strategy, the withdrawals remain 100% tax-free.
That structural reality completely eliminates the risk of oversaving.
Yeah.
The absolute worst-case scenario for aggressively funding an HSA is that at age 65, the excess capital simply functions as a traditional IRA. You receive the upfront deduction, you got the tax-free growth, and you pay standard income tax on the exit. It's a heads-you-win massively, tails-you-still-win scenario.
It completely de-risks the long-term accumulation strategy. And as you enter that post-65 phase, the definition of what constitutes a qualified medical expense expands in highly strategic ways, specifically regarding insurance premiums.
Let's delve into that because Medicare is notoriously complex. Can the HSA interact directly with Medicare costs?
It can. and it becomes a primary funding mechanism. Once you're enrolled, you can use your tax-free HSA dollars to pay your Medicare premiums. This specifically includes Medicare Part B, which covers your outpatient services and doctor's visits, and Medicare Part D, which covers your prescription drug plans.
Furthermore, our sources indicate you can use it for long-term care insurance, which is increasingly vital as actuarial lifespans extend.
Yes, you can use HSA funds to pay the premiums for tax-qualified long-term care insurance policies. The IRS does impose annual limits on how much of the premium can be paid tax-free from the HSA, and those limits scale up based on your age, but it's an incredibly efficient way to fund a notoriously expensive insurance product.
However, the Schwab documentation places a massive, bold warning regarding one specific type of Medicare insurance that is strictly off-limits.
Medigap, also known as Medicare Supplemental Insurance. These are the private policies you buy to cover the deductibles and copays that standard Medicare doesn't pay for. Due to a highly specific and somewhat arbitrary legislative quirk in the tax code, you are absolutely prohibited from using HSA funds to pay the premiums for Medigap policies.
That's such a weird exception.
It is, but it's the rule. You can use the HSA to pay for the out-of-pocket costs that the Medigap policy doesn't cover, but paying the premium itself is a non-qualified expense and will trigger taxes and penalties. It is a critical administrative trap to avoid in retirement.
Okay, we've traced the timeline from the initial payroll contribution in your 20s through the shoebox strategy in your 40s to navigating Medicare at 65. The final stage of this analysis is legacy planning. We must discuss death and inheritance, because the tax treatment of this asset upon death is drastically different from almost any other financial instrument, and if misunderstood, it can detonate a massive tax bomb on your heirs.
If we connect this to the broader picture of estate planning, the HSA is arguably the most volatile asset in your portfolio regarding inheritance. The outcome is entirely binary, and it depends exclusively on the identity of the designated beneficiary.
Let's outline the ideal scenario first. The policyholder passes away, and they have designated their surviving spouse as the primary beneficiary of the HSA.
In that scenario, the transition is frictionless. The IRS essentially allows the surviving spouse to step directly into the shoes of the deceased. The account remains an active health savings account, now legally owned by the spouse. It retains its full tax-exempt status. The spouse can continue to invest it, watch it compound tax-free, and use it completely tax-free for their own medical expenses.
It survives intact. But what happens if the policyholder is single, or if the spouse has already passed away and the HSA is left to a non-spouse beneficiary, like an adult child?
This is where the IRS drops the hammer. It triggers a concept called income in respect of the decedent, or IRD. If an HSA is inherited by anyone other than a recognized spouse, the account instantly and irrevocably loses its status as an HSA on the exact date of death.
It just ceases to exist as a tax shelter.
Completely. And the financial consequences are immediate. The entire fair market value of the account on the date of death is instantly converted into taxable ordinary income for the beneficiary in that calendar year.
Let's model the impact of that. Suppose a diligent investor executes the shoebox strategy for 30 years and builds a $300,000 HSA. They pass away and leave it to their 45-year-old daughter, who is currently in the peak earning years of her career. The IRS is going to take that entire $300,000 balance and stack it on top of her existing salary for that tax year.
That is exactly what happens. It will almost certainly push her into the absolute highest federal and state marginal tax brackets. A massive portion of that inherited wealth will instantly evaporate in taxes.
Is there any way to mitigate that?
The only minor relief valve the IRS provides is that if the beneficiary uses funds from the account to pay any qualified medical expenses incurred by the decedent prior to their death and pays them within 12 months, that specific amount can be deducted from the taxable total. But the vast majority of the balance will be taxed brutally.
If we analyze this through the lens of strategic asset location, this rule fundamentally reverses conventional retirement spend-down logic. Financial planners generally advise retirees to spend their standard taxable brokerage accounts first, then slowly drain their tax-deferred traditional 401ks and preserve their Roth IRAs until the absolute end.
Right, because a Roth IRA is the holy grail of inheritance. If you leave a Roth IRA to an adult child, they inherit a tax-free vehicle. They're required to drain it over 10 years under the new Secure Act rules, but the withdrawals remain tax-free.
But the HSA inheritance rule turns that logic upside down if you don't have a surviving spouse.
It dictates a complete strategic reversal. If you are a single retiree or a surviving spouse whose ultimate goal is to pass wealth to the next generation, your HSA is suddenly a toxic asset to hold at death. Your goal should be to aggressively drain the HSA during your final years to fund your lifestyle, cashing in every single historical receipt from your shoebox strategy and paying your Medicare premiums while deliberately preserving your Roth IRA. You want to die with a massive Roth IRA to hand to your children and an HSA balance of zero.
It is a masterclass in understanding the rules of the game. It isn't just about accumulating capital. It's about sequencing the deployment of that capital based on the underlying tax mechanics. We have covered a staggering amount of technical ground today, from the actuarial math of high-deductible risk transfer and FICA payroll bypasses to the 12-month testing periods of IRA rollovers and the lethal tax implications of non-spouse beneficiaries. It is time to synthesize this into action. For you, the listener, absorbing this theory is irrelevant if you don't actually change the plumbing of your finances. Your mandate today is singular. Do not passively move on to the next task. Contact your HR department or log into your health insurance portal and scrutinize the legal designation of your current health plan. Look specifically for the HDHP classification. Verify that the deductible exceeds the $1,700 or $3,400 thresholds. If you are eligible, your immediate next step is to initiate the account opening and automate a monthly payroll contribution. You have to activate the machine.
And as you implement that mechanical step, I want to offer a final conceptual framework to mull over. Throughout this deep dive, we have discussed the HSA strictly within the current paradigm of medical care funding hip replacements, covering high deductibles, navigating Medicare premiums. But we are currently standing on the precipice of a radical shift in biotechnology.
What do you mean?
Over the next 2 to 3 decades, as the capital you invest today is quietly compounding, medical science is advancing toward therapies that don't just treat acute disease, but actually target the fundamental cellular mechanisms of aging itself.
Okay, and if we look at the economics of the insurance industry, they're designed to repair you when you are broken. They have zero financial incentive to cover elective preventative therapies designed to keep you biologically optimized.
Exactly. When these longevity therapeutics eventually reach the market, traditional health insurance will almost certainly classify them as elective or experimental. They won't cover them. Access to the future of life-extending medicine will be entirely dependent on out-of-pocket capital. So when you look at that aggressively invested, highly compounded HSA in your portfolio, don't view it merely as a defensive fund for when you get sick. View it offensively. It could literally be the dedicated asset class that buys you an extra decade or two of healthy, optimized life.
That completely recontextualizes the value of the account. An HSA is not going to generate the viral excitement of trading speculative assets. It is methodical, it's structurally dense, and it requires discipline. But it is quietly serving as the most mathematically flawless wealth-building tool available in the modern tax code. Take the time to understand the mechanics, bypass the friction of terrible employer platforms, and let this unparalleled vehicle drive your financial independence. Thanks for joining us on this deep dive.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.